Well, stocks in the red this morning as investors weigh signs that the surprising resilience in the U.S. economy might be starting to show cracks. Both the S&P 500 and the NASDAQ composite trying to shake off some jitters here, but feeling the pressure on disappointing manufacturing data. So how should you play into the market right now? Here to weigh in, we've got Jessica Inskip, Director of Education and Product over at OptionsPlay, and our very own Jared Blikre over there at the Wi-Fi Interactive. Take it away.
Yes, thank you, Brad, and thank you, Jessica, for appearing here today. We're going to talk about the SPY, and if you follow me on Twitter, that's my handle, @SpyJared. But here we are. These are record highs right here. We are off just a little bit. This was just a tiny, tiny little correction. What's your view on the market right now? And just tell me how you would play this in options.
Yeah, absolutely. And from a technical view, this is an engulfing pattern that gives us a bearish flag.
Right here.
Exactly. And so this gap right here is means of support. So from a technical view, I would want to understand my sentiment. Do I expect volatility and uncertainty to increase? Am I going to be bullish perhaps to that top where we were? And how would I position an option strategy utilizing that? So yes.
Here it comes, here it comes.
Here it comes. Yes, so that option strategy here, if this is my means of support where this gap is, I want a gap up. But this is my stopping point. Options can be directional, but we're in the middle here. So we can either A, position a trade here that's going to benefit as long as the security doesn't move and doesn't go as high here. That'd be a cash secured put.
Okay.
Or, excuse me, a short call. I do a credit call spread there. Or I can do a cash secured put here on the upside, or a call that's a little more speculative, but it'd only be to this spot, which puts probabilities less in our favor.
So you could bet that the market goes nowhere or just a little bit upwards. It's like a slightly bullish bias to it.
Exactly. And since we're in that blackout period with the Fed, there's uncertainty. Uncertainty and volatility go hand in hand.
Yes.
I would stay on the side of selling, which has higher probabilities of success because we're just selling the volatility. Once that collapse and uncertainty is removed, then you have higher probabilities of success. And just like if you delete.
So if you're selling options, though, that could mean a lot of risk. It depends on how you play it, though.
Correct.
So how do you interpret what we're looking at here?
Yeah, absolutely. I love this chart that you put together. So on
I stole it.
Oh, that's fine. On the selling side, though, this is high volatility. So we have high volatility. If we have a naked put, this obligates you to buy the underlying security, but this means as long as the stock or indices remains above the current price, you're going to make out okay. It's not largely directional. It's neutral with a slight directional bias. But a short call spread, you're mitigating your risk. So if I were to sell a call at those all-time highs, I would cap my risk because I'm obligated to sell the security. I need to create a buy at a further out of the money, and that's how you create the spread, and that's the way that I would position that in this current environment, is selling a credit call spread right at those all-time highs.
All right.
Like we showed on S&P 500.
Great. And I want to move on to Apple. This is a different stock, a different look here. I'm going to show a 2-year chart so I can show just the trading range. This goes back about a year, and you can see we're at the upper end of this trading range right now. Which of these strategies are you thinking about to I guess, fulfill your view here on Apple?
Yeah, and I really think they're related because Apple is a huge component of the S&P 500. And in order to overcome when we're range bound or looking at these all-time highs, we need a catalyst. We have WWDC coming in.
That could be a big one.
Very, very soon. It could, but that's expectations. There's uncertainty, which means.
So maybe sell the news, or you're just talking about volatility?
Volatility, exactly. So in this case, there are two options. Selling the credit call spread would be a similar scenario. However, I do expect a catalyst. We've expected AI. I would accept stock ownership in something like Apple. Therefore, cash secured put.
All right, so let's go back to our 4 square here. Where does the cash secured put fall in this square?
Yeah, so this would be the naked short put. It's naked, meaning you just have a less of a requirement, maybe 25% of the exercisable value rather than 100%. That's the variation.
All right, so here is our options chart, and this is what you're considering doing, selling the June 21 $190 put for $2.50. Just kind of outline the risk and reward here.
Absolutely, beautiful. So right here, this is 190. This is where at the stock I need it to remain in order to be profitable. But because I'm selling this out to June 21st, I'm collecting $2.50. That represents this area here. So I've reduced my break even to 187.50. So I have this cushion. If Apple were to move adversely, the news weren't taken very well, I would be obligated to buy the security at 190, but it's offset by that premium of 187.50. If it continues to decline, I still have full stock ownership.
Which was kind of the goal in the first place, maybe.
Exactly.
Such optionality here. Jessica Inskip, always great to have you here. Back to you, Brad.
All right, thanks so much to both of you. Jessica Inskip, OptionsPlay Director of Education and Product, and our very own Jared Blikre. Thanks so much.